What would happen if on Monday, this past Monday, Etsy suddenly stopped to function? You knew today wouldn't be complete. It would not be complete if we didn't talk about the economy, specifically the bank failures that seem to be abound. Or are they? Is the entire system on the verge of collapse? Or is this just a bunch of tech dude bros panicking because for the first time in their lives, they couldn't get what they wanted? Is crypto finally experiencing what we've all predicted, that it's going to crash and burn? Let's find out. So last Friday, the collapse of the second biggest bank in US history happened in less than 48 hours. Then two more fell, and now another one needs an influx of cash. How did we get here? Does this signify a coming contagion of bank failures? Is our money safe? We're going to talk about all that and more, so let's go ahead and get to it. First up, let's talk about Silicon Valley. The Silicon Valley Bank. At the start of business last Wednesday, Silicon Valley Bank was a well-capitalized institution seeking to raise some funds, per CNBC. A downward spiral began late in the day when the company surprised investors with news that it had needed to raise $2.25 billion to shore up its balance sheets. In other words, it found itself being short on cash. Within 48 hours of that announcement, a panic induced by the very venture capital community that SVB had served and nurtured ended the bank's 40-year run. Peter Thiel, a massive backer of the likes of J.D. Vance and Blake Masters, had his venture capital firms, all of them, direct all their portfolio companies, every single venture capital firm, and every single company that those firms represented, to withdraw their funds from the bank. Every single one. That's a lot of companies. And what followed from that was the rapid collapse of a highly respected bank that had grown alongside its technological clients. Quote, "This was a hysteria-induced bank run caused by venture capital." Ryan Falvey, a fintech investor at Receptive Ventures, told CNBC News. Continuing on, he said, quote, "This is going to go down as one of the ultimate cases of an industry cutting its nose off to spite its face." By Friday, banking regulators had shuttered SVB and seized its deposits in the largest U.S. banking failure since the 2008 financial crisis and the second largest ever. Startup clients withdrew deposits to keep their companies afloat in a chilly environment for IPOs and private fundraising. SVB found itself short on capital. What ended up happening? So let's say that again. As startup clients withdrew deposits to keep their companies afloat in a chilly environment for IPOs, initial public offerings, VC funded companies have large stack cash reserves because they're just given a bunch of cash, and they started to have to draw on it. And this made SVB be short on liquid capital. So it had been forced, the drawing on these funds over the last few weeks have forced to sell off all its available for sale bonds at a $1.8 billion loss, the bank said on Wednesday. In other words, it took high-rated securities and sold them on the open market for a loss of what their value represented. The reason for that is because why buy a 10-year treasury note with a 2% interest when you can buy a 10-year treasury note with a 4 or 5% interest? You wouldn't. So they had to sell it at a loss because they needed capital, because a lot of capital had been withdrawn over the last few months. Pretty simple stuff. So all told, customers withdrew a staggering $42 billion of deposits by the end of Thursday, according to a California regulatory filing. $42 billion, roughly a fifth of all the money that existed in this bank, like money, quote unquote, like, the assets wise. By the close of business that day, SVB had a negative cash balance of $958 million, according to the filing, and failed to scrounge enough collateral from other sources, the regulators said. Balve, a former SVB employee who launched his own fund in 2018, pointed to the highly interconnected nature of tech investing community as a key reason for the bank's sudden collapse. A venture investor, TSVC, partner Spencer Green, also criticized investors who were wrong on the facts about SVB's position. Quote, "It appears to me that there was no liquidity issue until a couple of VCs called it," Green said. Continuing on, "They were irresponsible, and then it became a self-fulfilling prophecy." According to S&P Global, entities had $151.6 billion in uninsured deposits at Silicon Valley Bank, or 93.9% of the company's total holdings, per the Washington Post.
That's crazy talk.
It's not crazy talk. This is crazy talk.
Then, Silvergate Capital, a crypto-focused bank, fell almost simultaneously with SVB. Now, talking a little bit more about SVB before continuing on to the other bank that we just mentioned, that we were about to mention. Essentially, like we said, it didn't have enough operating capital to meet all these withdrawal demands. As this person said that there was not a liquidity issue until a couple of VCs called it. What they are saying is basically one venture capitalist said, I was told that I'd have to wait to pull out $250 million today, or whatever the number was. I'm making numbers up. Okay. Well, that's not good. I'm going to pull all my money out because obviously something is going on. And hey, friend, ex-business partner, get over here. You got money in that bank, SVB? Oh, yeah, I got money in that bank. Yeah, what's wrong? Get it out now. Get it out. It's going to collapse. And it just kept tumbling and tumbling and tumbling. Because that's how a bank run happens, everybody. Happens because we have fractional reserve system, which allows banks to loan out money. And when any one person decides to just rip all their money out and tell 5 of their friends, 20 of their friends, 80 of their friends, especially if those friends are sitting on fat stacked cash, it can cause a bank run. And that's what happened here. Now, Silvergate Capital, on the other hand, might have just been a crypto thing. There's not as much information about Silvergate Capital. It fell pretty much simultaneously, but it doesn't appear to have fallen for the same reasons.
Given the fact that Silvergate really does have a front row seat as essentially the bridge between crypto and traditional finance, as we see more headlines, whether it's the BlockFi bankruptcy, headlines this morning about Genesis looking to avert a possible bankruptcy filing, other firms halting lending and other trading services and activity. How dire is the situation in the crypto market right now?
Yeah, good morning, Morgan. It's good to be with you again. So the way I think we should be thinking about this is I think we need to zoom out. I just heard you mention the price of Bitcoin and ETH both being down this month. And, Silvergate has been banking this ecosystem for 9 years. So this type of volatility is not new to us. And in fact, we've built our platform to help our customers through both the good times and the challenging times, such as we're experiencing now.
It's a crypto-friendly bank, and shares are just totally sinking. I mean, that feels like an understatement. We're down by 50% in 2 days. Joining us now to discuss Bloomberg's Katie Greifeld. Katie, what's happening?
It's brutal. So the big news yesterday for this crypto-friendly bank, and it is a bank. It's a traditional bank that provides traditional banking stuff to crypto clients. So yesterday it came out, it said it's not able to file its 10K, which...
Let's continue on to this other bank. Yeah, less than 10,000, thanks Changebox. Yeah, less than 10,000 customers at SVB. Ridiculous. Bank boost over 9,000 business, 9,500 business clients. Yep. They had a ton of business clients. And so a bunch of businesses relying on payroll, pulling all their money out at once when they're sitting on fat stacks. What's going to happen? We got to continue on with the story because there's more to talk about. So Signature Bank also failed. And what happened? So after SVB failed, this past Sunday evening, Deadline reported that New York state regulators took over Signature Bank, a banker to crypto clients. Signature had recently indicated plans to retreat from that business, but customers grew concerned recently given its high share of uninsured deposits, especially in the wake of Friday's collapse of SVB. In other words, oh no, they're going to wind down from crypto. That's my business anyways. And we had this other tech bank over here collapse. There must be something wrong with this bank. There's got to be something wrong with this one. Oh no. Oh no. Oh no. So they pulled out our money as well, and that bank also failed. Now, federal regulators have seized control of Signature Bank, and whoever buys Signature Bank must agree to give up its cryptocurrency business, sources have told Reuters. All three of the now defunct firms serviced crypto-related clients. All three. But Signature Bank board member Barney Frank said the bank was solvent and that regulators took over to send a very strong signal against crypto, told CNBC News. He added, quote, "We had no indication of problems until we got a deposit run late Friday, which was purely contagion from SVB." Yeah, it was a contagion, but you're also involved in crypto, and crypto is kind of funny, kind of scummy, kind of not producing anything of actual tangible value right now. So why would, and a lot of crypto, not blockchain, there's a difference. A lot of crypto is running afoul of Fed bank regulations, SEC regulations, Security Exchange Commission regulations, Treasury regulations, etc. And if that bank was really wedded to that industry, and it's been breaking the law or skirting on the edge of breaking the law for a long time, of course the federal bank is not going to let it continue on if they sell it to somebody.
More bad news coming to light for Signature Bank. U.S. prosecutors were reportedly investigating the now failed bank for its crypto client work before it was seized by regulators. That's according to Bloomberg. Yahoo Finance's David Hollerith joins us with the details. So, David, I guess not a big surprise here that crypto was somehow involved in one of these banks. It's a tangled web we weave here. What are the details?
Yeah, so Jared, like Silvergate Capital, which voluntarily shut down less than a week before Signature was closed, Signature was a crucial U.S. banking partner for crypto businesses. And as of the end of December, it was the largest U.S. bank in terms of crypto deposits. And as far back as late November, Signature had made efforts to say that it was reducing its exposure to crypto deposits as a share of total deposits. They plan to drop that from 20% to 15%.
Now, a bunch of crypto heads think this is just the federal. This is just the Fed trying to exert its dominance over the currency markets that we're finally breaking away from. Okay, I find that to be nonsense. Not because I find crypto itself to be nonsense. I don't think crypto itself is nonsense. I think a lot of it is nonsense, but not the idea of blockchain and crypto in general. But no, dude, like scam. There's been what, 8 freaking failures of crypto exchanges in the last 3 months? Fuck out of here. And the other reason, like we were saying, with the fact that it was running afoul of all these regulations, Signature was also reportedly under investigation for possible tax money laundering monitoring by the Securities and Exchange Commission and the Department of Justice before it was seized. Because of course it was. It's a crypto bank. Crypto, as it currently exists, is used for, we'll say, 3 main things: scamming people out of money, money laundering, and tax evasion. We'll say, instead of tax evasion, general criminal enterprise to include tax evasion. So yeah, duh. So before we continue on, with Yellen's thing, I do want to address a good point that Changebox is making. Thank you for being very interactive today, man. It's been really good. So he said, quote, for SVB, the average account was $20 million. Who doesn't know that you are not insured that much? And these are tech bros, geeks, nerds. How did they not read the signs everywhere? So let's talk about that. Actually, I won't talk about that yet. I will answer that at the end because there's more facts to go over. But from here, just I'll quickly say that up until the Federal Reserve started raising rates, SVB was doing everything right. This isn't to say that SVB wasn't mismanaged once the Fed started raising rates. That's not to say it was mismanaged. It was or was not mismanaged. It more than likely was, but it was actually doing the right things up until that point. So let's go ahead and continue on. Now, we'll be moving on now to a Janet Yellen clip. All right, so Janet Yellen got a minute and 42 seconds or 48 seconds. She's going to say some stuff. I'm going to explain some things. We're good. Let's go.
Proceed.
Thank you. Chairman Wyden, Ranking Member Crapo, and members of the committee, thank you for inviting me here today. I'd like to start with an update on the recent developments in the banking system. This week, the government took decisive and forceful actions to stabilize and strengthen public confidence in our financial system. First, we worked with the Federal Reserve and FDIC to protect all depositors of the two failed banks.
So the FDIC is the Federal Deposit Insurance Company. It was set up, I want to say in the 1930s after the bank runs of the Great Depression, in order to prevent people from losing all their money. Generally speaking, and it only insures up to $250,000. However, by request of the Fed as well as other government agencies, that up to requirement, that maximum coverage can be waived in extraordinary circumstances. It's rarely used, but it was used to cover all SVB's deposits. My opinion on why that is the case is because so many tech startups used SVB as their primary banking. This includes my best friend's employer. They used this bank and another bank because venture capital were given good rates from there as far as loan terms and that sort of things, that it posed a systemic risk to the tech sector itself. So picture this, okay? One of the companies that was heavily involved with SVB is Etsy. It handles all its banking through this bank, not just its own payroll to its employees, but also people that use the site to do transactions. The money goes from one bank into SVB, and SVB sends that money to the other bank. So they handle that. What would happen if on Monday, this past Monday, Etsy suddenly stopped to function because they could not take deposits or withdrawals because they didn't have any capital? How many people would suddenly be in a panic because their sale on Etsy that they were relying on in order to, make ends meet or their hobby or what have you, suddenly vanished? And that's just one company. So yeah, that's why this is being done. Let's continue on.
On Monday morning, customers were able to access all of the money in their deposit accounts so they could make payroll and pay the bills. Shareholders and debt holders are not being protected by the government.
And that is why what she just said is why I am not considering it a bailout. Shareholders and investors, so direct investors, people with equity stake that might not have bought shares on the open market, are not having their assets given to them. In fact, they might have to take a cut on the assets from the sale of the bank because the bank is going to be sold. It still has assets. That's how the FDIC is going to be recapitalized. That's how these things are done with. So it's really important to understand that as of right now, regardless of what anybody's telling you, people on the far right, my right, or the far left, my left here, regardless of what they're telling you, no taxpayer money is being used at this juncture to save these deposits. None. Yeah, real huge improvement over 2008, but it's really the least they could do. Yeah, no, true. And I think there's more that can be done, and I do believe this Congress, will try to do more. But right now, got to avert a crisis. So, boom, let's do that. All right, let her continue on now. Nope.
Importantly, no taxpayer money is being used or put at risk with this action. Deposit protection is provided by the Deposit Insurance Fund, which is funded by fees on banks. Second, the Federal Reserve is providing additional support to the banking system with a new lending facility.
This new lending facility is actually really good, and it is one of the reasons why the Fed exists in the first place. This is important. I'm going to explain it if she doesn't explain it fully.
This will help financial institutions meet the needs of all of their depositors.
Let's come back over to the front here. We got to explain this because this is important. The Federal Reserve is acting as the lender of last resort in order to shore up banks from collapse. What we recognize when the Federal Reserve was established and its establishment was being the lender of last resort was that at times market failures happen. Regardless of what anybody else does in the banking industry, there are times where it's simply not enough to rely on market forces in order to cover externalities, unforeseen circumstances, random mess ups, whatever you want to call it. What the Federal Reserve is offering is basically collateralized debt loans. So, banks that bought treasuries at 2% 10 years ago, 4 years ago, last year, okay, when rates were low, are going to be allowed to use those treasuries as collateral debt for short-term loans from the Federal Reserve that will have interest rates set to a certain amount to prevent them from playing games with free money. Hopefully, that's what I'm thinking is happening here. That part's not not proven yet. So let's say what's been proven. So they're allowing banks with treasuries, high security, high value collateral, high value debt, to be used as collateral to get short-term loans to meet cash obligations, to meet liquidity obligations. So if a company has $10 million in value of, we'll say, treasury notes, T-bills, T-notes, and it needs $10 million in cash, it can go over to the Fed, give them the treasury notes, and say, I would like to make a $10 million loan based on these treasury notes. Please do that. And the Fed will be like, sure, here's the terms of the loan, here's your cash, go handle your business. 3 months from now, you are going to pay us back with interest, and we'll give you back your debt. Sounds fine to me. Don't know about y'all. But that is what's happening here. That is not a government bailout. That is not tax dollar money being used to bail out banks and shareholders. That is meeting short-term liquidity issues in the very way that the Fed was designed to do. And it's designed to do this to prevent massive bank runs and credit collapse of economies. Well, let's go back over to Janet Yellen. She's only got about 30 seconds left.
I can reassure the members of the committee that our banking system is sound and that Americans can feel confident that their deposits will be there when they need them. This week's actions demonstrate our resolute commitment to ensure that our financial system remains strong and that depositors' savings remain safe.
That concludes the clip. Continuing on, there's been other news that's developed. So another bank, this comes from NPR. So today brought news from NPR that a group of 11 lenders including JP Morgan Chase, Bank of America, Citigroup, Wells Fargo, said that they will deposit $30 billion into First Republic Bank in an effort to prop up the mid-sized lender. Now, federal regulations, even before Trump, did not pay attention to medium-sized lenders. They only paid attention to too big to fail lenders. Medium lenders might be too big to ignore, is what a lot of Fed watchers and people from the Fed and regulatory agencies are saying now. Meaning they don't necessarily need to be regulated in the same way as banks that are too big to fail, but they do need to have eyes watching over them. Okay. First Republic Bank was another bank that had some contagion risk from SVB, because it was also involved in high collateral issues with companies. Not in the same way, not as systemic, but it too was missing some of those obligations because it too was not able to sell what used to be as good as cash for cash anymore. So the banks themselves decided to be like, this bank, we're going to capitalize you so you can meet all your obligations. And so they deposited into those banks. So we got another video to show you about this that's talking about that aspect of it. So let's go ahead and go over to it.
We have some breaking news on First Republic. A deal has been announced to invest a total of $30 billion into the bank. A group of banks, 11 in total, agreeing to deposit $30 billion to help stabilize this regional bank. You're seeing shares pop just about 13% here.
Now, this was one of those banks that also was experiencing a massive drop in its stock portfolio because of wider concerns about the banking industry in general. Okay? A lot of the stuff that we're seeing right now that is like, people are like, oh, banks are on the verge of collapse, is really how contagion and panic actually drive markets. Markets are not rational. They are irrational beings that happen in times of relatively stability, appear to be rational. They're not rational. They act like a mob, and a mob being driven by algorithms now, especially.
In the final half hour of trading. Now, in terms of who is donating what or who is depositing what, Bank of America, Citi, JP Morgan, Wells Fargo, all contributing $5 billion of deposits each. Goldman and Morgan Stanley each depositing $2.5 billion. Then you have Bank of New York Mellon, PNC, State Street, and U.S. Bank each depositing $1 billion here. A total being deposited of $30 billion again into First Republic Bank to help stabilize this regional bank here.
And this regional bank, what was it? First Republic, I believe. First Republic Bank region area. New York, California, Massachusetts, and Florida. I wouldn't call that regional. Bank and provider of wealth management services headquartered in San Francisco and caters to low risk, high net worth individuals. It operates 93 offices in 11 states, primarily in New York, California, Massachusetts, Florida, San Francisco, and California. Either way. So let's talk about this now. So this is important. So the rescue comes after confidence in smaller lenders cratered following the collapse of SVB and Signature. In other words, panic was starting to set in. Quote, this action by America's largest banks reflects their confidence in First Republic and in banks of all sizes, and it demonstrates their overall commitment to helping banks serve their customers and communities, the lenders said in their statement. Regional, mid-sized, and small banks are critical to the health and functioning of our financial system, the statement said. California-based bank First Republic had experienced an exodus of depositors since the failure of those two banks, as many of its customers moved their money to larger rivals. In other words, people that heard about SVB failing due to venture capital taking their money out said, well, this bank is a California bank. Maybe all California banks are susceptible. I got to put my money in a bank that I know is going to have it. Let's put it in a JP Morgan Chase and all that stuff. So essentially, JP Morgan Chase and these other banks got this massive balloon of deposits, and they're like, oh shit, we're not going to be safe if all these banks start collapsing. Let's take that money that we just got and deposit it right back into those accounts under our names. And they stopped a run from that bank. So the bank, First Republic, has said that its balance sheet is sound and the depositors are safe, but investors have still worried they were vulnerable to a run on deposits because a lot of people started taking their money out. Like SVB, First Republic was founded in California, and it caters to wealthy individuals and businesses, as we previously stated. On Wednesday, Fitch Ratings and S&P Global Ratings both downgraded First Republic's credit rating as well. Examining its decision, Fitch said that the bank's, quote, focus on wealthy and financially sophisticated customers in select urban coastal markets in the U.S. has led to a high proportion of uninsured deposits. In other words, a bank is not safe if it caters to rich people. Yeah, 200 million is considered mid-sized because JP Morgan Chase and other banks like it are sitting on 500 billion plus. Total deposits only. What's 100,000 billion? Okay. 2,253,000,000 in total deposits, 1,906,000 in total deposits, 1,479,000 in total deposits, 1,282,000 in total deposits, 442 million in total deposits, 395 million, so on and so forth. These are just deposits in the biggest banks in the United States. TD Bank is TD Ameritrade Bank. The Bank of New York Mellon is another big financial bank. Capital One does all the credit cards. Like, these are huge players that are too big to fail. This is just deposits. So yeah, too big to fail is too big to fail. As sad as it is. So I had to put that in perspective. So that's why when you just cater to these sophisticated people, in other words, people that know people that also have a bunch of money, they can be like, hey, this bank just denied a loan for my friend. They must not have the capital. Let's run. And it starts a panic. That's why you need a diversification of not just assets, but of depositors. If you cater just to the rich and powerful, if they get a bug up their ass, they're going to cause problems. Now, the credit agency also suggested it is likely First Republic customers would take their money elsewhere if the lender found itself under more pressure. Their deposits, quote, can be less sticky in times of crisis or severe stress, Fitch wrote, because their wealthy clients, they can go anywhere. They don't even have to stay in the United States. They can transfer their money to a Swiss bank. They don't give a shit because they have so much money, people will cater to them. They will jump through hoops to sit on that nice cush. Let it rain down with all the debt that we can make from these banks. I mean, this is making me almost anti-fractional reserve, I swear to God. I'm not, because it would slow down things into a crawl, and that's bad in other reasons. But it does show you that there are issues when you have systems set up like that. So if you cater to a bunch of rich people, those rich people are just going to go elsewhere. Furthermore, according to an analysis by S&P Global Market Intelligence, at the end of last year, 67.7% of First Republic's domestic deposits were uninsured by the FDIC, meaning they exceeded the regulator's $250,000 limit. Let's repeat that. 67.7% of the First Republic Bank deposits were uninsured. We live in this crazy world because people trust the system. And as soon as the trust in that system breaks, it shows it's not like a house sitting on stilts and sand. It's not like a house of cards, but it does show that it is fairly fragile because, again, we have a fractional reserve system. Banks are not required to have a one-to-one dollar deposit for your deposits. Why we have these insurance. But this is also why some people are saying that the FDIC should just insure all deposits. And you know what? There's something to that, in my opinion. There's something to that. But wait, there's more. Again, I'm not saying this is contagion, okay? This is how panic does. This is not contagion. Panic can cause a bunch of problems everywhere, especially if you're involved in crypto. So concerns of contagion and increased regulation and just some general profit taking caused European banks to post their worst day in more than a year on Monday. The heavy sale continued on Wednesday, with Credit Suisse itself falling over 24% in its stock value. According to Credit Suisse's chairman Alex Lehman, any contagion effect from the recent collapse of Silicon Valley Bank is local and contained. And I believe it. I believe it. I believe that Credit Suisse would be fine. It, just like any other bank in existence that wanted to have money-making deposits, bought treasuries. Every single central bank in the world raised interest rates, which made old treasuries not as worthwhile. And if you're a large bank, medium-sized, if you have over 250, whatever, it doesn't freaking matter, right? If you have a significant amount of capital, that's how we'll phrase that. If you have a significant amount of capital and you wanted to protect it and make a little bit of money off of it, you bought government securities because those were as good as cash. But that's only true if rates stay relatively the same or go down. If rates go up, it being as good as cash isn't so much the case anymore. Because again, why buy a treasury bill at 2% interest when you can get one at 4%? It's simple. It's very simple. So now we need to talk about why this happened. Talked a little bit about it, but there's some things that we haven't said. So let's go ahead and talk about some of those things we haven't said. So this may be the latest fallout from the Federal Reserve's actions to stem inflation with its most aggressive rate hiking campaign in 4 decades. This is something that I believe. The Federal Reserve can steer the ship, but it can overcorrect. And when it overcorrects, it breaks things. And that's probably what we're partially seeing now. So, the New Republic, a left-leaning news source, posits the failures are due to the rollback of Dodd-Frank during the Trump administration. In May of 2018, Donald Trump signed into law a bill rolling back Obama-era Dodd-Frank regulations enacted to take on too big to fail financial institutions in the aftermath of the Great Recession. The rollback raised the asset threshold from banks subject to enhanced scrutiny, like stronger regulations and stress tests, from $50 billion to $250 billion. SVB and any other bank would have been required to do the stress test. Would that have stopped this from happening? That is not sure. Should these banks be regulated in the same way as too big to fail? Possibly. I am not an expert on that, but we cannot say for certain that this would not have happened because the banks weren't properly collateralized due to federal rate hiking. It is my opinion that even if federal regulators were in charge of these banks and which still had to monitor these banks, that it could have caught some of the lack of due diligence that was going on. Some of the bad malinvestments that were going on. Malinvestments being, not winding down their treasury, their treasury deposits, not deposits, their treasury portfolios quickly enough in order to buy as good as cash now treasuries, or having a hedge against time. This has a specific term, but I don't remember it. But basically, there's a time horizon for when a treasury bill is good, and we're beyond that basically now for a lot of these older treasuries. They didn't hedge against that. But one thing that we can say that it's not, though, is that it's not because of wokeness. And of course, everything Republicans don't like, everything conservatives don't like, always comes back to wokeness. The wokest. And according to Republicans, it's gotta be the woke. That's why SVB failed. According to MAGA World, the fault of the failure falls on nothing but wokeness. Too much time spent on diversity, equity, inclusion, ESG. Oh my God. Environmental regulations. And not enough time spent on the brass tacks of making money. Of course, none of these banks, none of these Republicans have provided any evidence to prove that SVB's policies on diversity and ESG and the rest of the whole shebang led directly to its collapse. Not only that, not only that, the amount of money and time that SVB spent on these programs, pittance. According to Politico, and I'm not going to dive into the article, but you can see it here. So according to Politico, SVB high-profile efforts to present itself as good corporate citizens makes for easy fodder. The bank's 2022 ESG report boasted plans to invest more than $16 billion in low and moderate income communities and climate-friendly businesses over the next 5 years. So 5 years, let's do the math, everybody. Let's try to find out how much that is a year. And I can't do math in my head anymore because I am lazy. That's just lazy. $3.2 billion a year for 5 years on average. So how much were they short? They were short like 20. Okay. This is basically part of their marketing budget. So I see nothing. At most, you can say they shouldn't have been investing in that. You can't blame it up for the cost. But despite this fact, it hasn't stopped Republicans from seizing on the woke Biden bank line as a convenient political talking point. And now we turn over to the Bird app to look at the calling of the woke. Ronnie Johnson, isn't he former White House physician? What the fuck does he know about anything? He said Trump wasn't obese. No, I'm kidding. I don't know if Trump was obese, but the point is like he is not a financial guy. He's a doctor. Stay in your lane, buddy. Anyways, the woke agenda coming from SVB is in large part to blame for its failures. How much money do they waste on financing ESG and CRT crap? The insane left-wing agenda is bankrupting our future. Go woke. Get broke. Okay. And then we got this video from the good old Fox News. So this is from James Comer. 20 seconds. Woke goes broke.
And then we see now coming out that they were one of the most woke banks in their quest for the ESG type policy and investing. This could be a trend, and there are consequences for bad Democrat policy. And I think we need to keep an eye on all the banking sector right now.
Well,
and then we see now
what you are seeing here, folks, is that banks are no longer providing as much money to Republicans as they once did. They are no longer pushing for just get rich and die trying policies because millennials and young Gen Xers that are finally coming into their own and their abilities to run companies are saying now that maybe just a little bit, we should go back to stakeholder capitalism. Maybe shareholder capitalism wasn't all it was made out to be. Maybe we should actually be good corporate citizens. But because that is not in the Republican agenda anymore, apparently, unless it's about cultural, not nonsense, it's important, but their cultural proclivities. They're no longer saying gay people can't get married, right? They're no longer saying that we should just drill for oil everywhere. That they're not having it anymore. And of course, nothing would be complete without talking about what DeSantis and Marjorie Taylor Greene said about the aspects. So we all know that you choose Changebox, you choose. So we all know that Florida Governor DeSantis, #1 Florida man, is trying to conjure the spirit of Donald Trump, even though he's still alive. So we're going to try to do the same thing here, what I say. Okay, how does he say? No, I can't do the voice. I'll try to do the hands. So, I don't have any specific information about any Florida bank similar to Silicon Valley Bank. And hopefully, that remains the case. I mean, this bank, they are so concerned with DEI and politics and all kinds of stuff. I think they're really diverted from their focusing on their core mission. DeSantis contended. And their core mission is making money. And how do you make money? Marketing is part of making money, dude. People care about the environment. All right. Now, Marjorie Taylor Greene summarized the situation from her point of view over on Twitter, saying, quote, "The Fed is extending loans against high quality assets to banks for nearly zero interest to prevent a run on banks Monday, all because SVB didn't insure over 89% of their deposits and instead hedged on failing funds that offered sustainable finance and carbon neutral operations to support a healthier planet." In other words, it's more than nonsense they're talking about. Now I will say that they should have hedged. You can buy private insurance for your own collapse to insure your depositors, and that probably would have stopped a run. Probably would have, but they didn't do it. Because why? Why do it? You had something that was as good as cash. In other words, the fools running the bank were woke and almost became broke, but the Democrat and the Fed swooped in to make sure their woke donors at SVB didn't go under. But how many other small banks will be swept up in this pending disaster? The serious threat here is that full loans on banks on basically next to zero interest from the Fed will drive down the value of assets owned by banks that aren't in trouble. And that will cause them to be in trouble. They are manufacturing a banking crisis. This should not be happening, Marjorie Taylor Greene said. Now, it's bullshit. They're not giving them basically free loans. They can't give them basically free loans because then that would just be used to buy more treasuries, would basically be free money. They are going to charge an interest rate that isn't free. Banks get cheap loans all the time. They get cheap loans. That's what banks do. They loan each other massive sums of money in short-term increments for reasonable rates, given the size of the loan. If you loan someone $1 billion and you charge 5% interest a month for 3 months, right? 0.5 times $1 billion, hundreds, thousands, millions, billions. All right, times 3 months, you still make $150 million off of that trade. That's why they do it, because the numbers are so astronomical that you don't need to charge a large amount of money because you know you're going to get paid back. And you don't need to charge a large amount of money because, one, you know you're getting paid back. 2, you got collateral for it already. So even if they fail to pay it back, well, I got all this money. I got these treasury notes or these securities, these debt obligations, whatever. They're worth the exact same amount of money. I don't need to charge high rates because I'm getting my money regardless. That's what's going on. So Marjorie Taylor Greene's full of shit. But wait, there's more here. Former Trump aide Stephen Miller has called on House Republicans to investigate how much time and money was spent on equity and climate scams, as well as which Dem entities benefited the most from SVB's risky behavior. But that wasn't the worst one. One that reached maximum chef's kiss level of cringe came from a Wall Street Journal columnist who took up the talking point in an op-ed on Monday. The columnist criticized the bank for tracking the diversity of its board, Black and LGBTQ members of Silicon Valley Bank's board. In a proxy statement, SVB notes that besides 91% of their board members being independent and 45% being women, they also have one black person, one LGBTQ person, and 2 veterans, wrote Andy Kessler. It's not saying 12 white men would have avoided this mess, but the company may have been distracted by diversity demands. Look, okay, 1, board of directors, they make decisions, but not really. 2, they, oh no, like, are you, there's no distraction. It doesn't, can you only rub 2 brain cells together at a time? Are you unable to walk and chew gum? Are you unable to see that we can have this minor thing over here that's really easy to fulfill, and then there's more complicated stuff that we spend 99.99999% of our time on? Holy shit! Jessica Tarlov, co-host of Fox News' top-rated show The Five, took aim at these ongoing accusations from the right. The discussion kicked off with a lengthy lashing of the bank and accusations from the other co-host that the bank had embraced rotten, Democrat-aligned policies that led to financial ruin. It's just dominionist bullshit, I swear to God. So obviously, investing in these things is good for the bottom line, and it's not just some woke venture. Who's on the board is not who's running things, Tarlov concluded. Jesse Waters shot back, well, who is ever running it is an idiot. They just got wiped out. Travlo replied, quote, Becker is an idiot, but that's not a wokeness initiative, and he's a white guy. Tralov, who also took pains to remind her co-host that one of SVB's top venture capitalists was none other than Peter Thiel, the MAGA diehard who poured tens of millions of dollars into Trump-backed campaigns during the 2022 midterm elections. Bottom line, what's clear is that wokeness has gone from being a ham-fisted shorthand for progressive overreach to a convenient, if lazy and illogical, explanation for every catastrophe. And what we do know is that yes, the banks were mismanaged to a degree. And yes, the Federal Reserve tightening changed the rules of the game midstream and caused problems.